All right, welcome back. Now we're into what I'm going to consider part two of our first lecture for chapter 10. And we're going to start right off on chapter 10, slide number 6. So the title of slide number 6 says Issuance of a Bond. Now, just to refresh, we're going to be talking about bonds and bonds payable. Throughout chapter 10. And one thing I want to drill into your head is that when you see the word payable, right off the bat, you should be saying to yourself, the word payable automatically tells you that something is a liability. With that being said, I want you to think back to your rules that I spoke about. How do you increase a liability account? Well, liabilities are part of the losers, so they increase with a credit and they decrease with a debit. So one thing I want you to keep in mind is think about your rules. Okay, I'm going to be talking about your rules when we're doing journal entries many times. Okay, so we're going to continue to go back to the ADE and the LSRs, which are your losers, and your ADE, the debits and the credits, which way they go up and they go down. So with that being said, please, if you need to, stop your video and pull out your lecture notes from financial with the ADE and the LSR rules on there. And let's get started. All right, slide number 6 talks about what we call the issuance of a bond. Issuance of bond is exactly the same thing as saying you're going to sell a bond, okay? Now, when you're selling something, there's 3 things that can happen. And the 3 things that can happen is what we're going to be discussing here. One quick point. If you see something out of color, meaning it's not in black and white, so for instance, if you're looking at slide 6, you'll see that there's some stuff written in blue. If you look at slide 7, there's a whole lot of stuff written in red. Obviously, that's being changed to colors to point something out, to highlight something for you. So whenever you see something of a different color, I want you to pay close attention to what that's being said and what it's saying to you, okay? It's important for you to do that. So the 3 situations whenever we issue a bond or when we sell a bond are what you see there. The first one, it talks about issuing a bond or a bond issued at face value. Now, if you think back to the first part of chapter 10 lecture that we just got done listening to, you would know that if you sell something at the face value, you're selling it for what it says it's worth on the front. So if you were selling a $100 bill at face value, you're going to sell that $100 bill for exactly $100. So if you look at what's written in blue, it says that the cash received will equal the face value. Well, that makes sense. That's like switching an old $100 bill for a new $100 bill. No matter what, each bill said $100 on it, and you got the exact same monetary amount in your hand, whether you have the old bill or you have the new bill. So in this case, whenever you sell a bond at face value, what I want you to pay attention to is the fact that if you sell something at face value, the amount of cash that you received is going to be equal to the face value or equal to what it's printed on the certificate. So if a bond certificate says the face value is a $1,000 bond and you were to sell it, you would receive $1,000 in cash. There's no difference between those amounts, okay? So the first way of doing it is selling a bond at face value. The second one talks about issuing or bond issued at a discount. Now, one thing I'm going to point out to you is that anytime you can relate accounting to your personal life, the better off you'll be. I understand, and some of you guys are probably, guys and girls are sitting there saying, well, what is this going to do for me? All right, I'm not an accounting major, blah, 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 blah. I understand that, okay? I completely understand that for some of you guys are not accounting majors. Some of you guys could be hospitality. Some of you guys could be just business management, human resources, whatever the case may be. I understand that. But I do need you to understand that, like I said, the more you relate this course to things in your personal life and things that you know, the better off you'll be. If you were to go to Woodbury Commons and go shopping at the outlets there, and you find a coat that is discounted, are you going to pay what the price tag says, or are you going to pay less than because it's on the discount rack? Obviously, you're going to be paying less because it's being sold at a discount. Well, here's the situation when it comes to a bond. If you take a look at what it says in blue for selling something at a discount, it says that the cash that you're going to receive is going to be less than the face value. Okay? So let's put this into perspective. If that coat has a face value of $100 and you sell it at a discount, the amount of cash you received is obviously going to be less than $100. Okay? It could be $99, it could be $80, it could be $40 that you receive. That doesn't change the face value of the bond. The face value stays the same. The amount of money that you received will be different. And in this case, if it's being sold at a discount, it is going to be less. So it could be any amount less than the face value. So in this case, any amount less than $100 for the example we're talking about. Everybody understand that? Just get the key point first. We'll worry about problems and putting numbers together afterwards. I just need you guys to understand the concept. If you sell something at a discount, you're obviously going to receive less money than you would if you sold it for, say, face value. Face value is 100% of the amount. If something says it's going to cost you $200, you're going to pay 100% of $200, which is $200. If you buy it at a discount, so let's say you're buying something that's normally the face value is $200, and let's say you're going to buy it for 50% off. Well, you're only going to pay $100 for that. It's less than the $200 face value. Now, moving to the third scenario is when you're going to pay for something at what we call a premium. If you pay a premium for something, that means you're obviously paying more for it. Okay? The example I always use is Black Friday shopping. Whatever, 6 years ago already, PlayStation came out with PlayStation 4, and it was the new big thing. Well, I knew my son was going to want it, so I went to Walmart, Black or Gray Thursday or whatever you want to call it. I left the Thanksgiving dinner table, which is not known for me to do, and went over to Walmart. I stood online for an hour. I was one of the 12 people that got a PlayStation 4 that day. As I was walking around the store with that PlayStation 4 in my shopping cart, I had somebody come up to me willing to pay me $200 to give them the PlayStation, and then they still had to go pay for it. So in essence, what I was going to go up front and pay $400 for, this guy was willing to pay a premium. He was willing to give me $200, plus that he had to give the store the $400 to buy it. So he was willing to pay more than what it was worth or more than the face value for something. So whenever you buy something for more than what the face value is, we're going to be calling that a premium. You're paying a premium for it. Okay, usually things that have the word premium, you're paying more for it. If you go out and you rent a car and you rent a premium car, you're not going to be stuck in a little Volkswagen Beetle. You may be stuck in, say, I don't know, a BMW. Okay, that's a premium car compared to a Volkswagen Beetle. Obviously, you pay more for the BMW than you would for a Volkswagen Beetle. So understand that if you issue a bond or you sell a bond at a premium, you're going to receive more money or cash than what the face value is. So in this case, if it's $100 face value you would receive money over $100. It could be 101. It could be 150. Any amount over that $100 is the premium. That is the point that I want you to get out of this. So the three main ways of selling a bond, three scenarios as I will call them, is to sell it at face value, sell it at a discount, or sell it at a premium. Now, what we're going to be doing here is we're going to be doing all three of those scenarios for every problem. And the reason for that is when a company goes out and starts to issue bonds, they want to find out the most favorable way for them to sell the bond. The markets, just like if you own a stock, bonds have their own, what they call bond market. Bonds go up, bonds go down. Stocks go up, stocks go down. Okay, same way stock market goes, there's a bond market. So everything has its little niche. So the bond market, if the bond market's going down, typically you're going to buy stuff at a discount. If the bond market goes up, typically you're going to pay for it at a premium. And then, of course, you have the last scenario, the first scenario, which is you issue a bond at face value. Here's what it's worth. Here's what you're going to pay. Let's go. It's either, take it or leave it. So please pay attention to the blue writing on slide 6. Again, I can't stress this enough. If you sell it at face value, that means the cash is going to be equal. If you sell it at a discount, the cash is going to be less than the face value. And if you purchase it at a premium, the cash that you receive is going to be more than the face value of the bond. Okay? Those are things that you're not going to have to write any of that out. You're not going to have to write that down for a test question, but you need to follow those rules. Okay? Please, 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 please. Slide 6 and slide 7 are two what I consider the most important slides in chapter 10. And those are, the reason is because those are going to give you the rules to follow to do the first 6 journal entries you're going to learn for chapter 10. Now, stop and think about this for a minute. And normally I'd ask for a show of hands, but obviously with this whole situation going on, I don't see you and you don't see me. If you didn't like doing journal entries in financial, you are definitely not going to be happy here. Okay? Now, I say that because out of the 2, 4, 5, 6, 7, 8, 9 chapters we do in this class, I believe 4 of the 9 have journal entries that have to be learned. And you must make sure that you know how to write a journal entry. So that's going to bring me to my next point before I move any further into the slides for chapter 10. I want to have you think back to financial. Okay? When you write a journal entry, you're always going to be putting your debits on top, your credits on the bottom. Keep in mind, you indent your credits. Okay? It's just like when you start a new paragraph of an essay. You hit tab, you start off indented. So make sure that your credits are indented. They should not be in a straight line going down the shoulder of your paper. If you want an example of what a perfect journal entry looks like, switch over to slide number 8. If you just take a look at slide number 8, you would see that cash is your debit. In this example, bonds payable is your credit. And notice how cash and bonds payable are not right up against the left-hand side. Bonds payable is indented a little bit. Same thing with the numbers. Bonds payable is slightly indented compared to the amount for cash. There's a couple reasons for that. Normally, you would be doing journal entries on work papers. Now, again, the unfortunate part, and yes, I understand this, and I stress this to the kids in my financial class when I teach it, you guys are learning the basics. You guys are learning things that in today's society, we don't do these things on paper. Okay. These are things that are done through accounting software. And it's tough because in all the years that I worked in public accounting, I used the software. The only time I ever did journal entries was at the end of the year. So for some of you guys, not being accounting majors, this is going to be not necessarily Greek to you, but you're not necessarily feeling like you're ever going to use it again. So just please bear with me, and please understand there's a reason why we set the journal entries up the way we do. I always like to tell students the reason the journal entries are set up the way they are makes it easier and quicker for us to grade things. So please just understand there is a certain way to write a journal entry. You should have been taught that in financial, and I hope that you were. Otherwise, if you, again, just take a quick look at slide number 8, you can see what a journal entry looks like and how it should be set up. Please follow those rules. I personally don't mind if you skip the date. I'm not going to ask you for dates on your journal entries, so you can skip the date part there. But I do want to see that your debit is all the way to the left. I do want to see that your credit is indented, and the same thing with your dollar amounts to the right of each account. Okay? Please don't try to cram them in. Take the extra time, put everything on one space, whether it be a homework assignment that I have you write out. I don't care if on our homework assignments, and I'll get into that later, I don't care if you type them up on Excel or whatever way you want to do it. That's all fine and dandy. Actually, I'd prefer that just because sometimes reading some of your handwriting is quite atrocious. But if you're that person that likes to write it out on paper and pen, that's not going to be anything that you will get points taken off for. It's fine. All right. So let's move on to slide number 7 and get right into the nitty gritty of bonds payable. All right. 2 rules when it comes to issuing bonds. The first rule I want you to pay attention to, I don't even want you to take a look at what it says second. I just want you to pay attention to the first bullet, and it says first. When we set up our journal entries, we're going to have a cash, we're going to have a bonds payable, and depending on the scenario, we're going to have another account. Okay? Now, what I need you to understand that in all 3 situations, whether you issue a bond at face value, you issue it at a discount, or if you issue it at a premium, in all 3 of those situations, the bond payable, meaning the amount that you put in for bond payable, will never change. Okay? Understand this. When you issue a bond, the amount of the bond payable, the face value of the bond payable, will not change. So what I want to do is, now we're going to be jumping slides here, so I need you guys to pay attention to what I'm going to tell you is happening. So the first slide I want you to take a look at is I want you to jump to slide number 8. If you look at slide number 8, we're going to build on each one of these slides. So if you take a look at slide number 8, it says at the very top, issue of bonds at face value. Now, if you remember from slide number 6, it said if you issue a bond at face value, the cash and the face value is going to be exactly the same. Now, here's the problem, and here's how things are going to be set up. It says on January 1st, Almond Corp issued a $200,000, 9%, 5-year bond at face value. Okay? Now let's just take a look at the facts of this bond. Number 1, the amount of the principal is $200,000. That is the amount or the face value of the bond. It's 9%, so we use that to calculate interest, which we're not even going to worry about that right now. I just need you to understand part of what a bond is it has periodic interest payments. So there's the interest rate. And then the next part says it's 5 years. We know that this whole chapter is talking about long-term liabilities, long-term being more than 1 year. So obviously this bond is a 5-year bond. So I don't have to pay this bond back for 5 years. And then the first scenario is we're going to issue it at face value. Now, steps that I want you to follow when you're preparing your journal entries is when you issue a bond, the whole purpose of you issuing a bond is so that you receive money. Okay, you're borrowing money from somebody. So the first thing I want you to say to yourself is, I'm receiving what in return? Well, in this case, you're going to be receiving cash. Now you got to think back to yourself. Cash is what type of an account? Cash is the number one asset that you could possibly have. So now that you know what you're going to be doing, your cash is going to be going which direction if you sell something. Okay, if you sell a bond, you're going to be getting money in return, which means your cash is going up. How do you increase an asset account? Back to our rules of ADE and LSR. Well, cash is an asset, which means it goes up with a debit. Hence the reason why if you look at the slide, the first line of your journal entry says cash, which is the account that will be increasing. It's being debited. And if you take a look, it's being debited for the amount, which is $200,000. Whenever you're doing journal entries for me, I always feel it's easier for you to plug in the numbers and stuff that you know, even if you just write down the account name. Okay? That is helpful not only to me, but it's helpful for you. So you know you're selling a bond payable, and you know you're selling it to get cash. So the first part, we know our cash is going up by $200,000. Now, what are we giving them? What's the other half of our journal entry? Well, we're issuing them a bond, which is a liability, which means we owe somebody something. Okay? This bond payable, keep in mind the word payable will tell you it's a liability. Bonds payable are long-term. And how much is this bond payable, or this bond that we issued, say it's worth? Well, it says that this bond is worth $200,000. So if you look back at slide 6, it said if we issue a bond at face value, our cash that we received and our face value are going to be the same. Notice your slide here. It says that cash is $200,000, and then your credit for bond payable is $200,000 also. Looking at that journal entry, now say to yourself, go back to your rules. Does that make sense? Well, rule on slide 6 says cash is going to equal the face value. Does it? In this example on slide 8, yes, it does, $200,000. On slide 7, rule number 1 said, whenever you're issuing a bond, the bond payable will be the same. In this case, it's $200,000. That's going to, rule 1 on slide 7 is going to come into play in the next part. So just disregard that for a second. So far, what you have right now is you've got 5 easy points on your first exam. Okay? When it comes to issuing a bond, there's 3 scenarios. There's face, discount, and premium. Every journal entry you write on your exam for me is worth 5 points. So here you just got an easy 5 points. Okay? That's the issue of a face value bond. You're issuing a bond at face value. You're issuing the bond for the purpose of getting cash. Okay? Let's move on to the next scenario. The next scenario on slide number 9, as you can see, talks about issuing a bond at a premium. All right? Think about this. If you issue something at a premium, or you buy something at a premium, that means you are going to be receiving more cash than what the bond is actually printed for. So one thing about this example in your slides, all the numbers are going to jive, okay? The numbers that we used for the first one are going to be pretty close to the same numbers that we're going to use for the example with the premium. So let's take a look on this one. It says issue of a bond at a premium. We know that if we issue something at a premium, the amount of cash is going to be what? Higher or lower? The amount of cash received is going to be higher. So here's what I want you to do. We know that we're going to be doing it to receive cash, which means our cash is going to be going up. So how do you show in a journal entry cash going up? But you give it a debit. So as you can see, we're debiting cash in this case. Don't worry about the numbers yet. Just worry. I want you to write down the accounts first. The next thing, what are we giving this person in return for that cash? Well, we're issuing them a bond, specifically a bond payable. And bond payable is a liability. Bonds, anything that's a liability goes up with a credit. Think of your AD and LSRs again. So your liability is going to go up with a credit. So as you can see, we have bonds payable listed as a credit amount. Now, disregard bond premium for a minute. Okay? So all you should see, or I want you to see, is I want you to see the word cash, and I want you to see the words bond payable. Now, here's where that rule that I said disregard before, here's where that rule comes into play. If you take a look at slide 7 in the red, it says that under the issuance entries, whether it's a face, discount, or a premium, it says that one number is going to stay the same throughout. And it says that bonds payable will always be the same. Okay? Bonds payable in the face value is $200,000. So if you apply that rule, bonds payable under a premium should also be how much? $200,000. Does everybody see that? So you've got one number. Now let's figure out the amount of cash that we're going to receive. Now, if we're selling something at a premium, that means the cash is going to be more or less than the bond payable. If you sell something at a premium, that means it's going to be more. How do we figure out that amount? That's your next question to me. All right. And as you can see from the narrative of the question, again, on January 1st, Almond Corp issued a $200,000 note, or $200,000 of 9% bonds. And then it says this number 103. Okay. That 103 stands as a percentage of. So what I want you to do is take the 103 and change that to a decimal. Okay? How do you change a percentage to a decimal? For those of you that are not understanding what I mean, if you look at 103, where's the decimal point? It would be to the right of the 3. So to change a percentage from a percent to a decimal, you're going to move your decimal point 2 places to the left. If you take a look by the number that you got for cash, which in this case it says 206,000, parentheses next to it shows you how they came up with that number. So take a quick second and open up your calculator on either on your phone, however you're listening to this lecture, or one of the requisites I would have if we were in class would be a 4-function calculator. Take 200,000 and multiply by 1.03. Now, if you go ahead and multiply 200,000 times 1.03, you'll see that you would come out to the $206,000 that they have listed under cash. Now, before we go into the next step, think about that. The amount of cash is more or less than the bonds payable. In this case, the cash that you received is $6,000 more. So does that jive with the rule from slide number 6? That's the one that's written in the blue. If you looked at that one and went back there, it said that if you sell a bond at a premium, the amount of cash that you receive should be more than the bonds payable. And in this case, if you look at that, so far, so true. Cash is 206. Bonds payable is at 200, which goes back to the rule on slide 7. Things should be all good, right? Hopefully you guys are shaking your head saying, no, this journal entry isn't done. Back to financial we go. One thing about your journal entries that you learned in financial, your debits always have to equal your credits. So taking a look at this example, so far we've got 206 on the left and we've got 200 on the right. That doesn't balance. So think about this for a minute. If you've got 206 on the left and only 200 on the right, you obviously need another credit so that your sides equal out. Now, the amount of money you need to credit on the credit side is pretty easy to figure out. You just subtract the 206 from 200, which leaves you 6,000. That 6,000 has to get put into a separate account. And the way we figure out what account we put it in is simply by what's the scenario we're working with. In this case, we're selling something at a premium. So the credit that the account that you're going to make up in credit is going to be called bond premium. Now, you know that the bond premium, obviously we need a credit for the bond premium because we need our journal entry to do what? And hopefully you're saying balance. So if I have $206,000 on the left and on the right side I have 200,000 and another account with 6,000, if I add those two up, that still comes out to the 206. My journal entry now balances. Okay? Keep in mind the rules again. I need you guys to understand these rules. If you sell something at a premium, the cash is going to be more than the bonds payable. The other rule from slide 7 said, anytime you issue a bond, in all 3 entries, whether it's face, discount, or premium, the bond payable amount's not going to change. So if you look back to slide number 8, where we did it at face value, bond payable was 200,000. Slide number 9, where we issued a bond at a premium, bonds payable was still 200,000. Okay. Now, with that being said, we're going to move on to the third scenario. That third scenario, obviously, if we did face value, we've done premium. The only logical thing that's left is going to be selling a bond at a discount. Now, before you even go any further, in the back of your minds, I want you to say to yourself, well, if I'm selling something at a discount, the amount of cash that I'm going to receive is going to be less than what it's worth. So at this point, I want you to jump to slide number 10. And again, keep in mind that all the information on these slides are jiving to be able to have you follow along the examples of what we're talking about. So slide number 10 talks about issuing a bond at a discount. Well, all right, let's tackle it. If you buy something at a discount or you sell something at a discount, the amount of cash that you would receive is going to be more or less than what it's saying it's worth. In this case, the discount is going to be less than the bonds payable. Now, as you do your first problem, which I will upload here later on this evening, I want you guys to go step by step by step. First step whenever you do anything for my class is read your directions. That is by far the most necessary step in everything. Read your directions. Okay? With that being said, here we go. Let's read the directions for this one. Issue a bond at a discount. On January 1st, Almond Corp issued a $200,000 bond of 9% 5-year bonds at 95. Okay? So the first thing that we know from rule number 1 on slide number 7 in the red was that bonds payable is going to be the same whether you sell it at a discount or you sell it at a premium or if you sell it dollar for dollar at face value. Okay? Whenever you issue a bond at a discount, again, the bond is going to stay the same. So that credit to bonds payable will be the same. As you can see, $200,000. You know that number is going to stay the same. So no matter what, write that down. Get used to putting down information that you know. So if you handle it this way, you'll get into a regimen and you won't forget things. You'll be less likely to make a silly mistake. Okay? So we know bonds payable is going to be $200,000. Now let's talk about the amount of cash. We know that cash is going to be less than because we're selling it at a discount. Okay? So let's take a look at what 95 stands for. What 95 means is that you're going to be selling that bond for 95% of its face value. Okay? You're selling the bond for 95% of face value. So let's take a look at 95% and change that to a decimal. So changing 95% to a decimal would be 0.95. And then the word of implies that you're going to multiply 200,000 times 0.95. If you take a look at the parentheses written next to the amount there, you'll see $200,000 times 0.95 gives you a total of $190,000. So at this point in time, you should only have 2 accounts written. You should have cash as a debit for 190, and you should have bonds payable as a credit for 200,000. Okay? Say to yourself, now, does this journal entry balance? And obviously it doesn't. We need to add 10,000 to the debit side or the right side to make sure that that matches or balances with the right-hand side. Right now, we've got 190 and on the left and 200 on the right. Now, if we sell something at a discount, that means we're going to be receiving less money. But we got to make our journal entry balance. So in this case, if you're selling something at a discount, you have to set up a new account called bond discount. Okay? Now, bond discount, in this case, you have to look at your journal entry and say, which side do I need that extra money on? And in this case, the bond discount is going to be 10,000. You subtract the 200 and the 190, leaves you with 10,000. That needs to be on the left-hand side, meaning it needs to be a debit so that each side will balance out at the end. If you take a look at the journal entry, you're going to have 190 and 10,000 on the left. And then all the way to the right, you're going to have bonds payable for $200,000. Now, what I want you guys to understand, and take a look at your rules again. The rules in blue said that if you sell it at a discount, the amount of cash received would be less. Is the amount of cash received here less? Obviously it is. The second rule, which is the rules in red, said under an issuance that bonds payable will always be the same in all three. So if you take a look at slides 8, 9, and 10, was your bonds payable the same amount in all three? They were all a credit for $200,000. Now, I'm not going to go further on going into any more materials with this. I just wanted you guys to get listening to this and looking at these example problems that are in your slides. First thing you need to know, the slides are there for you to go over with me in class. These are the same slides that are going to help us get through this semester. The point I want to point out, I told you each journal entry is worth 5 points on an exam. We just did 3 journal entries. That is 15 points out of 100 on your first exam. I also gave you 2 questions earlier in part 1 that were one-word answers. Those could be worth anywhere from 2 to 3 points apiece. So right now, as of this moment in time, you have approximately 20 points of your first exam that we're going over stuff. Okay? What I'm going to do now that you've listened to the second part of the first lecture is I am going to set up a example problem in which there'll be a video for you to watch and an Excel spreadsheet for you to bring up and watch as I do it. And then you're going to have an assignment that you're going to do. Okay? That assignment would be due by next Thursday. Let's call it this coming Thursday. So that would be September 10th would be the next, is going to be the assignment that's going to be due. Best way to do that assignment is first follow along my instructional video that I will post and tell you what it's about, and then go ahead and do your problem. We're going to go into the second half of bonds next week on Tuesday. This week is solely going to be getting you guys able to write up journal entries from the problems that I'm going to give you. We are only going to do the issuance entries at this point. We're not going to work on the second set of journal entries. We're only going to do the issuance of a face value, premium, and discount. Okay? Those are the 3 journal entries that I'm worried about that I want to go over this week. So it's imperative that you follow along, pay attention. Now, when I go through the instructional video, listen to my directions. That's key. Okay? So I am going to stop this video here. That's going to be our Tuesday lecture, which will be September 8th lecture, part 2. There's 2 parts, 2 videos. So please go ahead, and I will be posting your homework assignment along with the instructional video that I will give you in a few minutes. But please make sure that you understand you will have a homework assignment that is going to be due on Thursday, and to follow the instructions that will be given with that assignment. Okay? I will speak to you guys soon. Keep in touch. Any questions, please feel free to email me.